Most UK property investors won't fail because interest rates are high. They won't fail because deals don't exist. And they won't fail because property is suddenly a bad asset class. They'll fail because the models they're relying on no longer work in the way they think they do. And most people won't realize this until it's already too late. In this video, I'm going to show you the exact numbers being pitched online and then exactly what happens in the real world. Over the next 24 months, we're going to see a quiet shakeout. Not dramatic, not headlines, just investors slowly realizing their numbers were built on assumptions that belong to a different market. And I want to walk you through why that's happening and the model I believe still works in this environment. Section 1. This isn't about interest rates. Every property cycle has a villain. Right now, it's interest rates. But interest rates don't kill deals. They expose weak ones. If a deal only works when the debt is cheap, refinancing is guaranteed, and nothing goes wrong, then it was fragile to begin with. What's really changed isn't property itself, it's the margin for error. And most popular strategies were built assuming that the margin would always be there. Section 2. Why I look at property differently. Before I go any further, it's important to explain why I look at property this way. At university, I studied economics, and a huge part of economics isn't predicting the future. It's analyzing models, understanding the assumptions they rely on, and asking one simple question. What happens when those assumptions change? Later, working in the city at the Big Four and an investment bank, everything revolved around systems and processes. You tested them, you challenged them, and when conditions changed, you didn't cling on to old assumptions, you adapted the model. That's exactly how I approach property investing. Section 3. The assumptions that's breaking first. The first assumption breaking is this. I'll just refinance my money back out. For years, investors treated refinancing like a formula. You spend X, add value, and you pull out Y. But that was never how valuations truly worked. It just felt like that because the market was rising underneath everything. Today, valuations are slower, more conservative, and far more evidence-driven. Surveyors aren't valuing optimism, they're valuing proof. And if your entire strategy relies on future events that you can't control, your deal is far riskier than it looks. Section 4. How that changed what I buy. When I first started investing, I did what most people do. I bought what everyone else was buying. 3-bedroom houses, standard layouts, standard refurbishments. When I applied the same economic thinking to property, something didn't quite sit right. If demand changes, if affordability tightens, if the lending criteria shifts, why keep buying the same asset everyone else is competing for with no differentiation? That's when I changed my approach. Instead of buying 1-bedroom flats, I started buying 1-bedroom flats that could become 2-bedroom flats. Nothing speculative, nothing exotic, just changing the underlying utility of the asset. Section 5. The free house pitch versus reality. This is where I think a lot of people are being misled, not deliberately, but by outdated assumptions. You may have seen something like this online. The buy-to-let dream pitch usually goes like this. You buy a house for £200,000. You refurbish it, spending £25,000. So you're all in for £225,000. After the refurb, it's worth £300,000. You refinance at 75% loan to value and pull out £225,000. And just like that, you own a house for nothing that pays you every month. On a spreadsheet, it looks perfect. But spreadsheets only work if the assumptions underneath them hold. The assumptions behind this model. Assumption 1. You're buying a £300,000 house for £200,000. That's a 33% discount. It's not impossible, but extremely rare. And rarity matters if you want a model that's repeatable. Assumption 2. Total costs of £25,000. But let's be realistic. Stamp duty alone is around £11,500. Legals say around £2,000. Valuation and surveys, £500. That's £14,000 gone before you touch the refurb, leaving about £11,000 to do meaningful works and cover any finance costs. That's not realistic. Assumption 3. That a simple refurb costing around £11,000 can add £100,000 worth of value. In today's market, that's extremely unlikely. Paint, carpets, and a kitchen doesn't fundamentally change an asset. Valuers don't reward hope, they reward evidence. The part they don't talk about, cash required. This is the most dangerous omission. To do this deal, you would need cash before anything works. Either £225,000 cash to buy outright, or more realistically, £50,000 for the deposit and £25,000 for the refurb and costs. That's £75,000 up front. People focus on no money left in, but ignore how much money did I need to start. Those are very different questions. My biggest concern is what I've heard people being told online. Things like borrow the money from friends and family, refinance later, and pay them back once the refinance goes through, or in 7 years once the property doubles in value. It all sounds fine in theory. In reality, it introduces risk you don't control. Valuation risk, timing risk, and relationship risk. And that's how simple property deals turn into complex personal problems. Why this model makes people stop. I'm not saying these deals don't exist, but ask yourself, how many can you actually find? How repeatable is it? How many people do you genuinely know doing this again and again? When the assumptions don't hold, the model breaks. And that's why many investors quietly stop. Section 6, bedroom creation. Let me make this practical. A standard 2-bedroom house in a good area attracts a certain tenant, a certain rent with a certain ceiling. But a well-designed 3-bedroom version of that same house attracts a wider tenant pool, commands higher rent, and becomes far more attractive to valuers. You're not asking the market to reprice the area, you're offering something scarcer within it. The same applies to flats. A 1-bedroom flat is often capped. A 2-bedroom flat in the same building and postcode suddenly attracts professional sharers, couples planning ahead, longer-term tenants. That shift alone can materially change income, demand, and valuation, without relying on market growth. Section 7, the cash flow illusion. On paper, many deals still cash flow, but paper cash flow often ignores reality. Voids, maintenance, management, compliance, refinancing risk. A deal that only works when everything goes right isn't a deal, it's hope. And hope is not a strategy. Section 8, multi-unit thinking. The same thinking extends to multi-unit conversions. When you correctly convert a property into multiple units, you're not relying on appreciation, thin margins, or a single tenant performing. You're creating income density. Multiple units mean diversified risk, smoother cash flow, and greater resilience. Even if one unit underperforms, the asset still functions. From a modeling perspective, this is a completely different risk profile. Section 9. A real deal I actually did. Let me show you a real example from central London. I bought a 1-bedroom flat in Vauxhall. The purchase price was £290,000. Stamp duty, refurb, legals, finance, £50,000. So the total spend was £340,000. I reconfigured it from a 1-bed into a 2-bed, and after completion it got revalued at £390,000. At that point, the mortgage company advanced me an 80% loan to value mortgage, so £312,000. I left in £28,000 in this project. Why these assumptions are different? The deal was based on robust assumptions. The layout genuinely allowed reconfiguration. Costs included everything. Valuation was based on sold 2-bed comparables. Loan to value was confirmed before purchase. Discount driven by condition and seller circumstances. I wasn't relying on huge discounts, cheap debt, or hope. I was creating real utility. Section 10. Why this model scales. I'm not obsessed with getting all my money out. I care about the return that £28,000 is earning, the risk profile of the asset, whether I can repeat this process again and again. I've done multiple projects like this. That's the difference between a strategy and a story. Section 11. Why cheap and low spend never made sense to me. This is why I've never been comfortable with buy the cheapest property in the cheapest area and spend the least possible on the refurb. If you want strong tenants, longevity, and defendable valuations, why create a product nobody actively wants? I'd rather buy slightly below market value in a good area and create something that stands out, not through over specifying, but by optimizing the layout, light, storage, and usability. Section 12, the queue of tenants effect. My goal is simple. I want a queue of tenants at my property. I want tenants asking, do you have any more flats like this in the area? Because when you reach that point, voids disappear, tenants stay longer, properties are looked after, and valuations become easier. Surveyors don't just value bricks, they value evidence of demand. Section 13, why this model survives. This model doesn't rely on falling interest rates, generous lending, or perfect conditions. It relies on real utility, real demand, and real differentiation. Even if markets slow, a property people actively want will always outperform one that simply exists. Final takeaway. Most investors won't fail because they were reckless. They will fail because they never updated their model when the assumptions changed. Property investing, like economics, isn't about being right once. It's about constantly asking whether the model still works. For me, that's why I focus on creating value, not waiting for it. If you want more content like this, grounded, practical, and focused on what actually works, subscribe.